As you can see on this slide, this session is focusing on the three key areas, which are the public interest entities, the technology-related revisions, and the upcoming new standards on sustainability and the use of experts. So we'll first start off by taking a look at the revisions to the code in regard to public interest entities. As you can see here, these revisions are not entirely new. The ISBA, or the International Ethics Standards Board for Accountants, issued them in 2022, and the MIA's Ethics Standards Board later adopted them in 2023. And as a result, the revised MIA bylaws were issued in August of 2023. As to why we are discussing them now, because these revisions officially came into effect on 15 December 2024. With that in mind, this part of the presentation is aiming to provide some key takeaways to help you understand these changes and what are their implications. So moving on, we'll take a look at exactly how the definition has changed. Under the revisions, the definition now sets out about 4 categories of public interest entities, which are a publicly traded entity, or PTE. This replaces the term listed entity. The second category, which is entities whose primary function is to take deposits from the public, such as banks or financial institutions. The third category, an entity whose main function is to provide insurance to the public. In general, this means insurance companies. And finally, the last category, which states that there are some entities that will be specifically designated as PIEs by local laws or regulations. Now we'll break those categories down a little bit further. On the first category of PTEs, I just like to clarify here that this means an entity or organization that issues financial instruments such as shares or bonds that can be transferred and traded through a publicly accessible market mechanism. So this generally means traded through stock exchanges or any other publicly accessible trading platform, which could be things like other over-the-counter markets, which could be available to the public. Again, this is effectively the term that replaces listed entity. This new term is broader in scope and could also result in other entities or organizations being categorized as PIE. So we'll move on to the last category of PIEs, which are entities designated as PIE by local laws or regulations. So I'd just like to highlight here for Malaysia. This includes entities listed under Schedule 1 of the Securities Commission Malaysia Act, which provides us with a defined list of what entities are identified as PIEs. So beyond the main definition of PIEs, the revisions were also enhanced to encourage firms to treat other entities as PIEs. When making this determination, firms should also consider the list of factors set out in paragraphs 400.40 and 400.24. So the next couple of slides are listing the factors, but we won't be going into too much detail. Firstly, it's the nature of the entity's business or activities. Certain industries or businesses may attract a greater level of public interest, whether the entity is subject to regulatory supervision. If it is subject to strict regulatory oversight, it may also indicate that there is a higher level of public interest in this entity. So size of the entity, significance to its sector that it operates in. If an entity is difficult to replace in the event of a financial failure, it may be considered to be having a high level of public interest. The number and nature of stakeholders. So companies with large and diverse range of stakeholders are also likely to carry greater public interest. And finally, potential systemic impact. Some entities may have broader systemic impact on other sectors or the economy as a whole in the event of a financial failure. So now that we've covered the main factors for determining a PIE, the code also lists some additional considerations that firms should take into account when evaluating the extent of public interest in an entity. So these are things like future PIE status. Firstly, firms also should consider whether the entity is likely to become a PIE in the near future. So for example, if a private company is preparing for an IPO or initial public offering, it may also warrant the same kind of independence considerations as a publicly traded entity. So whether if a predecessor firm has also applied PIE-related independence requirement, it may also be worth assessing whether these should continue. Factors like legal or regulatory exemptions, maybe there are stakeholder requests, or whether there are complex corporate governance structures. So moving on to the next slide, we'll just want to highlight this potential impacts of this revised definition that some firms and their audit clients may have to consider in terms of the revision. So with a more inclusive definition, what will happen is some entities that were previously not considered PIEs may now fall within the classification. And beyond the mandatory criteria, firms may also voluntarily apply PIE independence requirements to certain entities if they have evaluated it to be necessary. So below in this this gray box here, these are some of the stricter independence requirements for the audits of PIEs. They are not exhaustive, but they are some of the things that would be relevant for you to consider. So when it is classified as a PIE, the firms would need to be mindful of the dependency on their audit clients, on their PIE audit clients. Firms should assess whether there is a significant portion of their revenue coming from a single PIE audit client, as this could create certain self-interest threats. Whether there are some long association or partner rotation requirements that would also need to be considered. Audit firms will need to ensure that key audit partners or engagement partners are rotated off after a set period to safeguard against familiarity threats. So firms will also need to take care to actively communicate with those charged with governance or TCWG regarding the non-assurance services provided and the level of audit fees. So, and there would also be certain prohibitions or limitations on providing certain non-assurance services, as Mr. Chong also has described in his earlier presentation, to PIE audit clients. So this next part is actually the one which is on the technology-related revisions. So just to provide everyone with some background of why have these revisions come about, the ISPA has observed that there have been major developments in terms of the use of technology for accounting, finance, and assurance functions. From the automation to artificial intelligence, because technology is changing the way we work, and the ethical standards will also therefore need to keep pace with the changes. And the main goal of the revisions is really just to ensure that the code remains relevant and fit for purpose in today's digital landscape, as well as help guide accountants in their ethical responsibilities when using new technologies. So in the final pronouncement, which also came into effect on 15 December 2024, the key revisions to the code are mainly in terms of enhancing it to guide mindset and behavior when using or when relying on the output of technology. It is also clarifying and providing guidance on when firms can or cannot provide technology-related assurance services to audit or assurance clients. So in the next couple of slides, we'll be touching on the key features of the revisions. The first being the provisions on the using the output of technology. As we are increasingly relying on technology for financial reporting, audits, and decision-making, the code is also now highlighting that we must exercise professional judgment when using technology's output to ensure that it's accurate, reliable, and appropriate. So these are some of the key factors that the ISPA has listed for us to consider, where essentially what it is that we must ask ourselves before relying on technology, what is it actually doing? Has it been tested? Do we have a basic understanding on how it works? And we also need to consider controls and governance. Who is overseeing its use? And is the input data reliable in the first place? And more importantly, we must also be mindful of certain biases when it comes to using technology. Oftentimes, we would make the assumption that that using the output of technology is often more reliable than manual process. If we are not aware of the potential biases, we also may be at risk at making wrong decisions based on inaccurate assumptions or on the simple premise that not entirely understanding how the technology is appropriate for use in the first place. So with that, it's also important to identify the type of threats that may be associated with the use of technology. Some of the examples the ISPA has provided are things like self-interest threats, which may happen if we rely on technology without proper assessment. For example, the data may be insufficient or inaccurate, the technology may not be suitable for the task, or the accountant may lack the expertise to use or explain it properly. So there are also examples for self-review threats, which will also come about when the accountant helps to develop or design the technology they later use, and this could affect their objectivity. So the code was also revised to clarify and provide guidance on when a firm can or cannot provide certain IT or technology-related services to an audit client. One key aspect to keep in mind here is the risk of assuming a management responsibility, which is something firms will need to be mindful of if they do offer IT services. So in the event a firm provides such services to an audit client, just do bear in mind that the client must accept responsibility for establishing and monitoring a system of internal controls. The client would need to be the one to assess the adequacy and the results of the IT systems design, development, and implementation. And also all management decisions relating to the IT system must be made by a competent individual at the client. And finally, the client will also have to be responsible for operating the IT system and the data it generates and uses. So overall, firms can support the client, but the client must remain in control of all the decision making and accountability to avoid the firms crossing into the line of having management responsibility. So some of the examples of services that could lead the firm to assuming management responsibility are things like hosting or managing client data, operating or maintaining the client's IT systems, or things like operating disaster recovery support. So, but just as a reminder, the ISPA has also provided a clarification here. There's a specific paragraph stating that the collection, receipt, transmission, and retention of data provided by an audit client, either during the audit process or to facilitate the provision of a service, would not result in the firm assuming a management responsibility. So can rest assured on that part there. So the next meaning, what are the other updates to the code that we are expecting? So these are things such as the sustainability and use of experts pronouncements. So okay, let me just move on to the next slide. So for the information of participants here today, the ISPA has also issued the final pronouncement on the International Ethics Standards for Sustainability Assurance, or the IESSA, and the final pronouncement on using the work of external experts. So why this is important for us to take note, because sustainability information is no longer just a concern for investors. Today, there are a wide range of stakeholders, including regulators and the public, who are relying on such non-financial data to make decisions. So the shift is also happening here in Malaysia, where the launch of the National Sustainability Reporting Framework last year also signals to us that the sustainability reporting is also becoming a key focus area for organizations and regulators. With the increase in the volume of sustainability data, there's also a growing risk of issues like greenwashing and unreliable claims that could be made with such non-financial information. So this also leads us to why there is a need to ensure that sustainability information is trustworthy, comparable, and capable of being independently assured. So why accountants are in a sense also involved is because our roles are evolving beyond financial reporting. Sustainability information is also increasingly being incorporated into corporate reporting, and assurance providers must also be prepared to be involved in sustainability assurance engagements. So the public and regulators will also be expecting the same level of objectivity, independence, and ethical behavior when it comes to sustainability assurance as they do for audits of financial information. And with this understanding, the IAASB, or the International Audit Assurance Standards Board, and the ISPA have worked closely to develop a set of interoperable global standards for sustainability reporting and assurance, which are the International Standard on Sustainability Assurance, the ISA 5000, and the IESSA. So what are we expecting exactly from the adoption of the ISA? It will essentially introduce a new Part 5 to the Code of Ethics. It is also a framework neutral standard, which means it applies regardless of the assurance framework used. It is also a profession agnostic standard, by which it means it's designed to be used by all sustainability assurance practitioners, regardless of their professional background. On the use of experts pronouncement, it was actually a project. Let me move my slides. It was actually a project carried out in tandem with the ISSA, as the ISPA observed that there was also a growing reliance on the use of experts in such areas as technology and sustainability. It will also be providing guidance on how to evaluate the competence, capabilities, and the objectivity of the expert, as well as further guidance on threats to the fundamental principles when using the work of an expert. So these standards are expected to come into effect in December of 2026. And so just as a heads up to the participants here today. And okay, that would bring me to the end of this part of the webinar.